So, Tabong, should
Yeah.
I pass the ball to you?
Yeah, sure.
Okay,
Um,
thank you.
okay. Hello, everyone. Can you hear my audio clearly?
Yes.
Yes, you are completely
Okay, good.
audible.
So we have part seven participant. Okay, on in this meeting room. Um, okay. So I think no harm. Okay, if we start now, right? 2 minutes to go. 2 minutes early. Right. So we have just three papers. So each presenting author are given as mentioned by Wilson. Okay, 20 minutes, 15-minute presentation, and 5 minute Q&A. So all these papers okay carry the same themes. Okay, which is investors or market investment bias. Okay, so it's a behavioral kind of studies. Okay, right. So the first papers is going to be presented by Muhammad Mubin, right? So yeah, I think we can
Yes,
start now. Okay, Muhammad, you can take over the screen. So whenever you are ready.
I am
Yeah,
completely
you can.
ready. I just don't have a camera to present. I will be sharing my screen just in a
Okay,
couple of
okay.
seconds.
Good.
I'm sure my screen is easily being
Yeah,
shared.
good. Your screen, okay.
Okay, so let me just give two
Right.
to 3 minutes.
Yeah.
No, okay. Other. Yes. So let me share it. Here it is. So I will be presenting on the topic of industry-wise sentimental herding, an application of state space model in Pakistan. So my name is Mohammad Bobin. I have done my MS in finance from Department of Management, Bilkent University, Ankara, Turkey, which is AAC accredited university. Right now I am associated with Iqra University, Karachi, Pakistan, as a lecturer in accounting and finance. So my just a brief about my co-authors. Kashif Arif, he is doing he is PhD finance candidate from University of Malaya in the faculty of business and accountancy. He is last year student, and my third co-author is Saima Sultana. So she is lecturer in Sunway Bath Business University, Sunway University, Malaysia. So first of all, let's start the research motivation. I started this research when I was doing my MS Finance study in 2017 in a course of seminars in investment PhD coursework. There I completed my research herding with terrorism in Pakistani context, which has been submitted in Financial Innovation, a paper SSC indexed after revision. So this current presentation is based on the extension of debt herding with terrorism. So in this paper I am just covering a very minor initiative. I have started my initiate work as to cover the geographical research gap, to identify how much diversification benefit we can achieve within industry and across industry if we are going to portfolio diversification, considering the investor sentiments, whether they are following each other or they are not following each other. So as an international collaboration, you can see like three different country has been participated. Pakistan, Turkey, and Malaysian. Three different authors are indirectly associated with this study. So first of all, I will be starting as a generic, not a finance specific discussion. What is herd behavior? Everyone know the herd behavior is something to follow in investment and finance. Herd behavior means to follow other investment strategy. If someone is buying a particular type of share, or if someone is buying a particular type of mutual funds, so other investor might think that as he is the market leader, yeah, he is a good investor, so why not to I should be following him. So in Bigchandani and Sharma, the intention of investor to mimic the behavior of other investor. They simply are replicating, mimicking the behavior of other investor, is known as herd behavior. So in herding behavior, which is the main one of the area of behavioral finance, the very first econometrics based study and technique was being introduced by Christine and Huang in 1995. They examine herding behavior during periods of market stress using but they introduce a methodology to capture the herd behavior, and in which they use the cross section standard deviation of return. That was a 1995 study. In 2000, Chung Chang and Khurana highlighted the linearity issue of Christie and Huang model. सही है. In Christie and Huang model, what they have introduced, they have just introduced the linear model, econometric model, but Christie and Huang said that the herding behavior may not be linear, so they include non-linearity in their model, and they examined the herding behavior in 5 different countries, namely US, Japan. So this was somehow extension of this. However, in 2004, Huang and Salmon severely criticized the both methodology, the methodology by Christian Huang and Chung Chang and Khurana strategy, because they were only focusing the returns and volatility. So Huang and Solomon proposed a model to capture the herding behavior that the cross-sectional variability should be beta sensitive. So they introduced another factor. They said that instead of capturing herding via cross-sectional standard deviation of return, we should be focusing the cross-sectional standard deviation of beta. So as a factor sensitivity. In 2014, again these models have been replicated. Christian Huang and CCK 2000 model has been extensive in by considering the issues of multi-currencies. So this was mathematical contribution. While we want to capture the herding behavior, so in term of methodology, these 4 paper has been considered as the seminal or timeline based papers. Maybe there will be some new studies in 2019 or 2020, but I have not incorporated them in my literature review, but I will be. So in Asian context, these are the authors. They have replicated these, their technologies different. Some have used CH, some have used CCK, some has used Huang and Salmon methodology, some has used Yao Ma and He tech methodology. In Western context, this paper has been utilizing, and they have their mixed result. As my particular paper is to calculate the herding behavior in Pakistani context, so these are the research paper which I found in chronological order, which have captured or applied or examined the herding behavior in Pakistani stock market under different conditions. For example, I found the one of the interesting paper by Jandir and Hanif. They applied herding behavior in Pakistani stock market using CH and CCK model, but they included, their innovation was to include macroeconomic announcement. Wherever central bank or government based monetary policy has been announced, or somewhat oil market price shocks has been announced, market oil price change has been announced. So what will be the stock market behavior during this particular announcement? So Jandira and Hanif examining the herding behavior around macroeconomic announcement, but again they use the methodology of CH and CCK, which I have already said that these have been severely criticized by Huang and Salman. So their methodology is a bit old. So in 2015-16, I just found that except Ahmed et al, all other authors were not able to apply Huang and Salman model to financial market of Pakistan. Why? Because I will see that somehow the methodology which I am going to explain in my coming slides, that it is a bit tedious, because it involves a lot of calculation if we do manually. But of course I have applied the R software, R code to capture the beta. So in Ahmed et al, they somehow applied the Huang and Salman model, but I will say their herding proxy for mathematical easiness was not as good as it was required. it was not as good as it was required, because they somehow not included the technical or critical part. So I will say they wrongly applied the, and their paper was not published in a good journal, but somehow they have incorporated the Huang and Solomon model in their paper. So, okay, so my objective of the study was to examining herding behavior in Pakistan Stock Exchange, and to determine how herding behavior respond differently in case of different industries with robust techniques of state space model. So state space model, I will be explaining this. My research design is completely quantitative. It is empirical, including daily frequency, high frequency data. In research method possibility, I have applied econometric model and state space model from the signal and noise theory. The Huang and Salman, which they have presented the model, it was based on state space model, and state space model is nothing but a concept of herding and noise behavior in telecommunication sector. Right now, like we can see that some signal is going on, but due to some unmuting of mic, I can hear some background noise. So my model is somehow applicable to the same concept, that signal, the main information is being communicated, and noise, the required information which we don't want to see in our communication. How I have applied this, I will be explaining this in my coming. So my research process, what I have done, I have in Pakistan Stock Exchange, although there are 629 firms listed at that particular time, so I have compiled the 554 companies data from 2000 to 2016. Data is old. I am working on updating the data in R code. Just I have to update my data, but this is work in process. So I am presenting the 8 as per situation. So I was having 400 to 4259 observation for each firm. So how many firms I have finalized? 420 firms. So what criteria I have used? Any firm which has been traded for more than 15 days in a year. So I have calculated the return of days. So to explain this, I will be saying that I was having the prices of A company, prices of B company, prices of C company, till prices of 420 companies. And in term of time dimension, I was having the prices from day 1 January 1 to prices of day 400 to 56. So the huge matrix data was available in my sheet. Then what I have done, I have calculated from the return the standard deviation, the beta, monthly beta, yani beta of month 1, beta of month 2, beta of month 3, till beta of month 196. How I have calculated? As we know, the beta will be covariance of firm with market divided by variance of market. So I have applied this, but in this it might be possible that some of the firms might not be having activity in a particular day. So I have selected only those firms which were traded for more than 15 days, 15 or more than 50 days. So there were 22 days stock market was working. So I have set the benchmark criteria of 15 days to acquire the monthly betas, and by this I was having the betas, monthly betas of these 420 countries. Then what I have done, then from these monthly betas of 1422 companies, what I have done, I have calculated the standard deviation of those cross section beta. So standard deviation of cross section beta. So I was having the one sequence series of cross sections of beta, for on which I have applied the statistics model. So it was a rigorous activity which may be done on Excel, but I have used the R software for to develop this code. Then applying state space model. So let me explain a bit about state space model, that how state space model is applied. So first of all, technically what I have assumed, the beta, the cross section of beta which I have calculated is bias beta. How this is bias beta? I am assuming this is bias beta, and this is untrue beta. This is basically true beta. So what is the effect, what is the difference between bias beta and true beta? I have included the effect element of herding. Sorry, basically this is not my work, this was suggested by Huang and Salman. So Huang and Salman have done this, the same thing in his paper. I am just replicating his explain. So right now I am explaining the technique of Huang and Salman. This is not my work, let me correct. So in bias beta and true beta, what they said, if there is no herding, if herding is 0, so all this effect will be 0. So true beta will be equal to the calculated beta. So we can observe this from data stock market prices calculation. If we are going to calculate beta, so we will be getting this, but we don't this is unobserved. We don't know is there any a true beta or not. If there is herding, let's say herding number is 0.1, so true beta will be different than by captured beta, observed beta, or bias beta. If herding is 1, so true beta will be different than, or if even herding is minus, still true beta will be different than bias beta. So if this state space model, what it is doing, it is calculating only with the observe. We only have to input this, only input this, and this input is being calculated here by cross section of standard deviation, cross sectional standard deviation of betas. So as by inputting this state space model as a black box magic, right now due to time shortage I am not going to explain this exact process in detail. So what they have done, they are identifying unobserved and a latent hidden factor, latent and hidden factor. So their state space model is calculating with the, we just have to give input. Normally what it is being happened in equation, if we have, let's say x plus y is equal to z, if we have two known, so we can easily calculate one unknown. But what if we have only one known and two unknown? So with the help of some econometric techniques and lag variable, say lag variable, they have calculated one unknown, two unknown with the help of one unknown. So this is was the technique of state space model. Now when we apply the same technique, we take the standard deviation, so we will be having the this background detail model. So standard deviation of bias beta is equal to standard deviation of true beta into 1 minus HMT. If we calculate mathematical manipulation we do, so we will be getting this technique. So state space model, the basic state space model which was presented was this, in which we can see we have to take the log. Why we have to take the log, I will be explaining, of course, due to resolve some of the issues of non-normality. So we will be having the mean time, we will be having the h, this h is nothing but the herding, and this herding was being captured by another second equation which we by including the lag of herding behavior. So again it is, yes, we have one known and two unknown, but second unknown missing has been introduced, has been captured by incorporating lag variable. So this was the basic state space model, and in our model what we have included, we have incorporated market return to control the effect. We have included the volatility, this is volatility, this is market return, and dummy variable of financial crisis, because the my period involves the financial crash periods also. So let's go toward the basic results. When we talk about the basic, when we first calculated the basic descriptives of beta including 2008 crisis, so we got these numbers. We can easily see the kurtosis and jaguar beta are reflecting the non-normality issue. Even we took the log, still non-normality issues were not resolved. However, when we our data was from January 2000 to 2016, and in 2008 we all know the financial crisis has affected all over the financial market. So what we did, we took out the 3 months 2000, after this was done after error and trial method. This was done after error and trial method. We have incorporated, we have seen multiple error and trial scenario, and we found out that if we are excluding the 2008 crisis, so our results are completely robust, are addressing the non-reality issue. when we are taking log. So we have applied all our result in the end after excluding the 2008 3 month financial crisis period and taking the log, and then
Mubin.
the
Sorry to
yes,
interrupt you.
yes, yes.
Can you finish wrap up your presentation in 4 minutes?
Okay, okay, okay. Yes, yes. I'm just on my results. So these were my descriptive. I took the same descriptive for industry-wise analysis, and in with out of these four, I have included the major industry. 87 were from financial, textile, sugar, fuel and energy, and manufacturing concerned. This was the overall result of statistics. I will be highlighting only the noise to signal ratio. The after applying exactly mimicking or replicating the Huang and Swang model, we found that in Pakistan stock market the overall holding ratio is 0.57. 57% information is based on signal to noise ratio. This is our signal and this is our noise. Yani this information includes total overall noise information, means general public are buying after seeing other and this is on the basis of true information. So this is 57. It results show, and also it also shows that the market volatility has negative effect of riding. If some companies are following positive returns, so people are following them, but if the risk is high in this type of country, so people are not herding in this particular direction. Not this was not only for overall results, but when I am seeing the industry results, so I can see that risk is negatively affecting herding, whereas return is positively affecting herding all of this. However, the intensity is not same as it should be. Our overall result indicate that the noise to signal ratio was 57, but when it comes to industry, so this ratio is being declined. So it shows that across industry, within some industry, some people are holding more and some people are holding less. So sentiments are less. Investor sentiments are affected due to industry differences. So this was I am skipping this graph. This graph has been taken from my earlier study where I was measuring holding with the effect of terrorism when people were in stress. So these periods were showing that as a journal overall industry, this graph is showing that in Pakistan, due to a lot of terrorism based incidents, stock market was being affected. So in this I have included this as a, so let me, my preliminary result is holding do exist in normal condition, but if I talk about the my earlier literature review, all of my studies were saying that there is no result of holding in Pakistan. The reason was that they were applying the old technology, which is only provable or applicable in the case of extreme market condition. That means these both of these techniques which were developed by CH and CCK were applicable for extreme market condition, not normal market condition. Whereas Huang and Salman introduced a model in which we can capture holding with not only extreme market conditions but also the normal market condition. So this was my results are supporting Huang and Solomon studies. The holding do exist in industry processes, and I am also working on investor sentiments that holding in COVID health sector versus not health sector. I am going to classify this my incorporate this part in my research also. So any suggestion or any question which you want to ask regarding this is a work in progress, and I just want to present to get the idea from some of the seasons researchers like you, so that you can incorporate and give some more ideas if you may find this research interesting. So thank you for your time, and your comments will be taken and incorporated while finalization. So that's all
Okay.
from my side. Floor is open for
Okay.
question
Okay.
answer.
Thank you, Mohammed. Mubin, for your presentation. Do we have any question? Okay, from the floor, from the audience? You can either type into the chat box, or you can just speak to your microphone. Okay, speak directly to your microphone and then post your question to Mubin. Guys, do you have any question?
Yes, I have a few questions slash comments, if I may.
Okay.
Yes.
You want the presenter to share the slide again?
No, no.
Maybe you
Actually, yeah. Well, there's one thing about the slides that I didn't quite understand.
Okay, let me share which
Yeah, it's
slide.
the overall result versus the industry segmentation, and I think one of the conclusions was that herding there's more. Yeah, exactly this one, the one before. So
Okay.
how is it that the overall herding is more at 57%, but when you decompose that into sectoral elements, it goes down?
Okay, so I will say there was one, if we add all of these companies, so I won't it won't be adding up to 420. So there was some minor industry sectors in which, like paper and cardboard company was only having like 3 firms, say. So there were some industries where the data was available for only 3, only either only for 3 firms or 7 firms or 8 firms, and those types of industry I included them in general or miscellaneous. So if I calculate their signal to noise ratio, it was too high. So the reason was that because general investor are not sticking to minor industry or small industry, so this herding behavior may I can relate this result in such a way that the investor which are herding are more prone to herd or invest in a big industry like financial, textile, sugar and fuel and energy and manufacturing, and not towards the small industry. So in toward the small industry, the signal to noise ratio was too high. Noise to signal ratio was too high. It was around 1.5, and it was having miscellaneous companies. So I have not included those in my presentation. So I think I will be answering like this. If you got what you want to ask.
Okay, so that's understandable, but I'm sure you can appreciate that from the reviewer's point of view, the result does appear a little misleading. And also, if those companies are not of economic significance or those industries are not large, it might even be possible to argue that winsorizing is a better way of arriving at a more substantial sample base. But anyway, I think that's acceptable. There's no major issue with that. Another thing that I noticed is
Okay, I will be. It means you are suggesting that when I am talking about overall firms of 420
yeah.
firms data, so and this is adding up to around, let's say, 280 approx. So do other 120 firms I should not be making part in my overall result data. You mean to say
Not
this?
quite, not quite. They can be differentiated because those are still part of the overall result, but you can try to add another dimension by saying that if we lump, I mean, pretty much the same explanation that you gave to me, you can make the same case just so that it does not confuse the reviewer or the editor, because uh, on the
Okay,
surface it does appear
okay,
as a discrepancy.
okay. I got that. Means adding that other in comments and discussion part in
Yes.
giving reasoning to improve the paper. Okay, I have not included this in my paper. I will notate this. Thank you.
Okay.
Thank you for your comment. Now
Now
your
I have
second.
more of a comment. I mean, behavioral finance is not really my area, but one of our audience members, Dr. Abdullah, has done his PhD on herding, and I worked on him with that project. And as you mentioned, that the CCK at the CH models were more suited for extreme market situations and does not take into account the actual state of the market, and that is a valid criticism. So what the approach that we did to overcome these issues is quite similar to the state space worldview. We looked at a regime switching approach. We used a Markov switching quantile regression approach. So our paper is still under review, but the suggestion that I had is instead of going by the industry sense, it might make more sense to go through market capitalization. So, for example, our result was a
Okay.
little different than yours for Malaysia, that we found that the large cap and the mid cap companies were more prone to hurting rather than the small cap, which is a little counterintuitive. But then when you consider that the major mutual funds and I mean the investment management industry rebalanced their portfolio, it could potentially make sense that hurting would be more in the more established sectors. So you could probably slice your data once again to reflect the market cap view of the same results, just to add some extra value to your paper. Yeah.
Excellent. I means I should be controlling for market capitalization to see the revised result, whether it is significantly affecting or not. Am I right? This is
Yes, I
your
mean
suggestion.
it would be even better to do
Yeah.
through
Okay.
the maybe the book value size or the accounting variable, but that's probably too much work. Market
Okay.
cap is
Okay. Okay. Thank you. Thank you for your comment.
Okay, thank you, Imjad, for your constructive comment. And we have one question, okay, from the chat box, okay, from Ahmad Maulin. He is asking about the implication, okay, what is the because I think you are suggesting that for your future research, you're going to look into the health and non-health sectors, right? So the question is about the,
Okay. Yes, sir.
implication, okay, or maybe the motivation for you to do this.
Okay, good. Yes, sir. This is work in process, and things to add. I have already decided to include the hiding and COVID related. Like as earlier said, this is work in process. Right now, I have result from 2000 to April 2016. So I will be incorporating 2020 December 2020 results, and COVID has effective. And our model holding says that if market is in stress, so results will be different. So basic model are for extreme market condition, but Huang and Solomon model is not only good robust for extreme market condition as well as good for normal market situation. So I will be applying basic CHCK techniques along with this data in health sector and non-health sector, and I'm sure there will be difference. So as you can say, investors are more prone to holding. So just to check test whether they are more prone, more hard, more holding in pharmaceutical sector only, or there is no difference. Because although yes, there are two type of, one type of investor is financial investor and other type of investor is real investor. It might be possible some investor are buying health sector and pharmaceutical companies, but in stock market sometime people are only not only not making the real investment but only the financial investment. So which type, so my holding pattern may give idea whether real sector investment is only increasing, or as well as financial sector other investors are being attracted toward health sector or not. So checking this result will show, then after result I can some link some implication whether this will be fruitful in portfolio diversification or benefit
Okay.
or not.
Okay.
Thank you. I hope I answered Ahmed
Yeah.
Maulin.
So since we're going to have only two papers, okay, the second paper will be for me. I think we still have some time for question, okay. Allow me, can you show us, go to your table 4, Mubin, your table 4. Can you
Yes,
enlarge? Yeah, table 4.
table
Uh, yeah, this is
table
the
for this
main
one.
result
Okay,
table,
thank
right?
you.
Can you enlarge
Yes, yes.
the screen, turn it to presentation mode? So this is
Okay.
something new for me. Okay, like how do you interpret the herding result? So intuitively, I can
Okay.
understand what is herding, as you said. Okay, we tend to follow some investment strategies or investment gurus, right? So can you explain? Maybe you just speak from financial and textile, right? Can you tell us, okay,
Okay.
which of these
Okay.
sectors,
Yes,
okay,
sir.
is more prone to herding, and which are the variables that you're looking at?
Okay, so I will be saying that the main final result, due to time shortage, I only stick to the word this signal noise to signal ratio. This is noise to signal, sorry, signal to
Right.
noise ratio. Signal to noise ratio means overall this log of standard deviation of captured beta. This is bias beta. Bias beta means as per my this model, it involves true beta as well as herding factor.
Okay, I got
Okay,
question here, right? So
whereas
like, you say that
so
you
yes,
got
yes, yes.
one main equation here, okay, at the beginning of the presentation, you say that bias beta is equal to true beta minus the herding beta, right?
Plus herding, okay, minus or plus, it's same. If yes, there is one component, it may be positive, it may be
Okay.
negative.
So what is the intuition of this equation?
Eh,
Why you lead
okay,
to the hypothesis of whether you got hurting or no hurting?
okay, so the I will be needing a blank slide for this, but let me use this here. See, what is herding behavior? In herding behavior, people follow others. So two type of in total observation, two type of people are there: people which herd and people which not herd.
Right.
Say, but if we are able to separate both of them and divide that people which herd are different than total, so this ratio is nothing but the manipulation of this concept which Huang and Solomon introduced in his main basic paper. So what he said this is true total,
Right.
this is total
Yeah.
bias. So in stock market, everyone, so the cross section it will be high, very limited, the cross section standard deviation which we calculated of beta. So if people are herding, so automatically cross section standard deviation will be low, and if people are less herding, so cross section deviation will be high. Means people are generally following, so everyone we will be converging toward one single point or one single prices, so there will be less differences. But if people are herding more, so there will be too much cross sectional standard deviation. So by having this intuition, he was able to differentiate that actual situation. Okay, my shit.
Okay, Rubin?
Hello, my internet got disconnected. Maybe.
Yeah. Can you continue? If
Okay, my internet just got disconnected and I am on backup. So yes, I have power
uh,
shortage issue. So I was here. So my one of the I am on right now backup of just 1 to 2 minutes of internet. So I was saying that these slides, my digital pad is out of my reach now. So I was saying that yes, on this slide. So what happened? Let me share like this. Yes, I was here. I was sorry to for this interruption. I am in right power outage issue, and I'm on my
yeah,
backup.
maybe just
So
turn
my
to
digital
table
pad.
four. Table four. Yeah, just
Okay,
table
table
four.
4.
Okay,
Yes,
just
sir, I was here. Okay, so noise to signal ratio this was calculated by this concept that this is true situation and this is sorry, noisy situation and this is
right.
total situation. So noise in out of total noise was 57%. So people are herding, whereas in industry based results noise is less. It means that people are more herding towards the good industry, large industries. Means if in you want to have if some mutual fund manager wants to include some of the firms from different industries, so which company should he focus, where people are herding more or where people are herding less? So in manufacturing sector or in financial sector, we can see that overall results are very less. Herding signal to noise to signal ratio is very low. Low noise to signal ratio means people are herding more, and if noise to signal ratio is high, that means people are herding
Okay.
less. So overall result were
So,
this. But yes, I hope I am clear
okay. So
on my
meaning
point.
that manufacturing sector should be the sector that hurting most, right? Based on your
So yeah, no, hiding. Yes, hiding more. People are more toward
okay,
following
and I
each
know
other.
your
Means everyone is buying similar type of us companies.
okay, and
Okay.
textile is the biggest sector in Pakistan, right? Okay.
Yes. So this, I will say that this is this is moderate. So people are some manufacturing and textile sector. We can see these are having low results or more result of herding. Whereas if we see financial sector and sugar sector, so they are having more as compared to more herding as compared to textile. Sorry, less herding as compared to textile. So in overall result, people are not herding the smaller companies. People are not following each other, or when it comes to small industry or when it comes to
Okay.
smaller companies in
So do
miscellaneous
you
sector. But
do
in
you have a
yes.
cutoff to say okay anything above this below this? No.
No. Even the presenter of the developer of this methodology, Huang and Solomon, simply said that it should not be one as a generic, because he somehow related market beta is one, so herding should be best situation is if there is no herding, it
Okay.
should be zero. So he gave, and then he presented intensity. He said that if it is more than 0.5, it is too much or too less. Let me show the equation. Yes, in this
Right.
equation.
Never mind. It's okay.
Sorry.
Moving. It's okay.
uh, okay,
Let
thank
us
you,
move on with
so
my the second presenter. Okay.
okay,
Which is me.
okay,
So thank you, Mubin. So you can stop sharing.
thank
I'm going to share my
okay, yeah,
slide.
okay, so
Okay. Right. Okay, so the second paper, okay, is by me, with my co-author Jupika and Rusmawati. Okay, Jupika is my PhD student. Okay, he just completed his PhD at UUM. So the titles, okay, this piece is mainly is extracted, okay, from his PhD thesis. So the title is Governance, Qualities and Momentum Return and International Evidence. So this is a good transition from moving paper to our papers, because moving paper talk about investor blindly, okay, follows, okay, maybe some investment strategy or some stock, okay, or some sectors uh, performance, okay, consider the fundamental factors, okay, of sector